Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Alrighty, we are back. How is everybody doing out there today? Hope you are doing well. Andrew Kuhn, Focused Compounding Podcast, coming at you here today from the sunny Dallas, Texas, here by myself. But we do have a special guest on the podcast, contributor to the website. His name is Alex Middleton. Alex, how are you doing today?
I'm doing great. Thanks, Andrew. How are you?
I am doing well, and that's the third time we've had to say that because I've messed up so many times. So I want to thank you so much for coming on the podcast here today. And if you do want to get access to Alex's write-ups for the site, he has contributed a lot to the website. Go to Focus Compounding and use the podcast promo code, and they'll take some money off of the subscription price. So today we're going to be talking about a company that he had written up called North American Energy Partners. When he wrote it up, it was around $8.40 Canadian. It's currently around $14.90 Canadian dollars, and then it has a market cap of 407 million Canadian. So before we jump into that, and maybe I should tell you, the ticker is NOA. If people want to reference it, at least that's the one that's on the New York Stock Exchange. But before we jump into the company, Alex, maybe you could spend a few minutes talking about your investing style. Obviously, here at Focus Compounding, we focus on the overlooked stock space, and I would certainly consider this stock to be in that category. But maybe you could spend a minute or so really just giving the listeners a little bit of a background on your investing style and types of companies that you look for.
My investing style, at least I look at a wide spectrum of companies. I don't just keep myself to micro caps or small caps. I look at large caps and mid caps. I follow a few investors on and take a look at their portfolios on Dataroma. And then I also subscribe to certain people's blogs, and so I get a lot of ideas that way. And even when people who follow me email me asking questions on certain stocks, I'll look into that sometimes as well. But I'm not specific to what I look at because I find even when I look at big companies that may seem really overvalued, I learn a lot from that stuff as well. So and that knowledge can apply to things I might apply to an overlooked or small cap stock in the future. So yeah.
Yeah, no, that is awesome. So North American Energy Partners, I'm always curious, especially when people do come across an overlooked stock. How did you first come across this company? Did you screen for it, or maybe you could tell me a little bit about that process?
So my background, I reside in Calgary, Alberta, and I used to work in the oil industry here for 10 years. And this is one company that is quite familiar to a lot of people that worked in the oil sand industry. It's a major contractor that does a lot of the earthworks, heavy civil mining contract in the region. So it's quite familiar, and especially I used to live up right in the oil patch up there, which is called Fort McMurray, and you hear about it more there too. So you end up, even if you don't deal with them directly, you see their trucks everywhere as well.
Wow, that's awesome. What did you do in the oil business? I'm kind of curious.
I was a supply management professional.
That's awesome. That's cool. So what does the company do? Maybe give a little bit of an overview on it. What kind of products do they have, or like what's their business? Who are their customers? I'm kind of curious to hear about it.
So their primary asset is just mining equipment. So if you ever look at pictures of a giant mine, their equipment is the biggest haul trucks in the world. So they have Caterpillar 797 mining haul trucks, they don't own those ones, but they own 777 Caterpillar mining haul trucks, which are a couple stories high and can carry 60, 70 tons per load. And so the companies will contract them out. So the owners of the resource, so the oil companies in the region, will contract them out to do overburden removal, which is like the top layer of soil that needs to be removed to get to the resource to be mined. And they might have also other projects that they contract North American for, like building tailings dikes, and various other earth type projects.
That's awesome. So does all the revenue pretty much come from that then?
Fair bit, most of it, yes. And then they also have another division where they contract out some maintenance activities. So they have a big maintenance shop to help service a lot of their equipment down in Edmonton, Alberta. And then because it's a little bit bigger than what they need for their requirements, they also search out business through other customers. So, a lot of the oil companies will own their own equipment as well. And, they might not have enough room, or they might be at a capacity in their maintenance facilities. So they might say, hey, North American, can you do some maintenance on this truck because we need it back and we don't have the space to do it.
Interesting. And I guess, I probably should have asked this a little bit earlier when we were introducing the company, but what was the float and I guess the volume like on this company? Is it more of like an illiquid stock? Did you have any issues getting into it or anything
like that? No, it's fairly liquid. You don't have to wait around too long to get your order executed. It's covered here in Canada. It's fairly well known. I mean, by the people who cover Canadian stocks and in the oil industry.
Sure. No, that's awesome. So if you had to describe, I mean, I'm always curious when, types of companies like this, do you think that the business has a pretty strong moat? I know you, in your write-up, you were talking about, you believe it's one of the most promising opportunities in an industry without a lot of optimism right now. That's what you wrote. How do you sort of think about that? And I guess, why do you think that?
Well, I guess to know the history about the oil sand industry in the past 20 years is, from 2000 to 2008 to 2010, it was a huge growth story. You had a lot of international oil companies coming in and investing a lot into, or at least developing plans in their pipeline to build huge projects out here, because the whole mentality around the end of oil was coming, and, Canada's resources was one of the last, opportunities to build up their reserves. And so there was a lot of investment coming in, and that was why North American construction was starting to get a lot of attention as well. They were bought by a private equity firm down in Texas called Sterling Capital or something, and that was on the premise that that all this growth was going to happen, and North American was going to be the primary contractor of choice to develop a lot of these oil sand sites where at least mining would be required. And we know the story from there. After post 2008, the oil sands became a lot less popular, and there was tons of contractors that wanted to grab a lot of that business too. So the mining contractors came in, and a lot of equipment came in. And they were bidding really aggressively to get business there. And then after oil went down, a lot of that equipment stayed because there wasn't anywhere else to move it in the world, because mining commodities prices went down as well. So a lot of these companies were just kind of hanging on, seeing if things recovered eventually. But eventually the prices just kept low, and a lot of these companies weren't making money. So all it took is a little bit of time before some of the companies went out of business or just folded up that part of their overall business and sold off their equipment or just closed down operations in the region. And North American was kind of one of the ones that stuck it out because they've been there for a long time. And I think what you're seeing right now is partly the recovery in this mini industry here up in northern Alberta.
Mm-hmm. So do you think about it like as a turnaround story, or how do you think about that?
Yeah, I think so North American is a bit of a turnaround story as well. And it also, because, they had built up a lot of debt, and they were in a little bit of financial trouble and had to sell off a division. But also it's a kind of a recovery in, there's only two pretty much operators in the region that can handle certain size scopes, some mining scopes in the region. Mm-hmm. And one of them just dropped out, and North American bought their assets. So that's how it went from 3 to 2. And then also I think it's partly a mini cycle in the region as well, in terms of at least earth moving large amount of dirt. After oil prices dropped considerably in around 2012, a lot of the oil companies up there started kind of deferring expenses to the future to preserve cash flows. And one of the major expenses they incur every year is moving this overburden to get at the resource. So they pushed that off in the future. And right around, 2016, 2017, that's when, they couldn't really push off those expenses anymore. So they had to do a lot of catch up, because in order to maintain their production levels, they had to remove all that overburden to get at the resource so they can process it and haul it to turn into oil, essentially. So it's kind of got like three different, variables at play here.
Mm-hmm, sure. And then in your write-up, one thing that I thought was kind of interesting, you were talking about, I believe, how management, they laid out like a goal to grow both revenues and EBITDA by 15% per year for 2017 through 2019, but 15% per year. So that's just all like on future projects that they expect and stuff, correct?
Yes, yeah. I think it's probably tied as well with volumes that they've probably been that have been shared by their clients or customers that said, hey, this is what we expect to move in the next 3 years, and they have like a 3-year contract with 2-year extensions or something like that. So they can they say we're going to grow it by 15%, so that's going to be based off volumes that probably been shared with them. Also, they have expanded outside of oil sands a little bit as well. So they work for a mining company that does copper and coal out in British Columbia. So that's outside their traditional territory of where they get most of their business. So they've expanded that way. So that's helped with their setting their targets.
Mm-hmm. That's interesting. Does the company have a lot of debt now? I know you said that they sold off some divisions before to sort of help with that debt.
They reduced it significantly when they sold off a piling division in 2012. But so this past year was kind of a transformational year in terms of, so back in 2012, they sold the piling division, and, they did fairly well over the next 4 years. Not great, but then they reduced their share count by about 30%.
Oh, wow.
And so then in this past year, and then 2017 was a good financial year for them. 2018, they've kind of been a little more aggressive with their future growth. They bought the assets of another mining company that was operating in the region. So Aecon Construction, which is more of a they're a big Canadian construction firm, and which had a large presence in the Alberta region for mining projects. But I think they're the one company that just kind of gave up and folded in that part of their business because they just couldn't make money at it. So can't remember what I was with that.
Yeah, no. I mean, yeah, and the reason, I ask, and I'm kind of curious about like the capital allocation, I guess when it came to their debt, because I don't know, sometimes a lot of times when you look at companies similar to this one, to North American Energy Partners, I'm always just curious to see like what their debt position is and what they're doing with the capital that they raise. So I was kind of curious with the capital allocation.
Yeah. So I guess like I mentioned, they reduced their share count by 30% in the past 5-6 years, and then this past year was kind of transformation because they spent $150 million to buy the Aecon's construction equipment, and they used primarily debt to do that. And then they also bought another mining contracting firm that's big in the Northwest Territories and Nunavut, which is where Canada's diamond mines are. So that was all done with a lot of debt. So last year their debt was long-term debt was $383 million, and with those acquisitions it went up to went from $70 million to $265 million this past year with those acquisitions.
Got it. And then I don't know if you touched on this a little bit earlier, but it looks like the revenue in 2013 was around $407 million, and in 2013 was $470 million, and in 2017 it was $292 million. What was the decline from? Was it just problem from like prices of the commodity in general, or what happened there?
From
2013 to 2017, why was there such a decline in revenue?
Oh, that was mostly the selling off that piling division.
Got it.
That I mentioned. Yeah. And then also, I think they were just being a little more selective with the projects they took on and the business they took on, and making sure that there was going to be profitable work that they took rather than competing at a loss.
That's interesting. So so it's currently around $14.90. How did you think about the valuation of the company, and how did you appraise it?
Well, I pretty much, because I knew the business so well, I kind of had an idea of what the cyclicality and there was a lot of upside in coming in the coming up for the company, and it kind of goes back to where, I don't know if you read Howard Marks's most recent book where he talks about cyclicality, investing with kind of momentum going up on the cycle and everything.
And then mastering the market cycle.
Yeah, that's right. Yeah, and so that was in my head. There was a lot more probability of having that momentum going up, because I knew that there was going to be a lot of work coming up for the company in the region. So, and then when I looked at the valuation, and compared it to Aecon, even though it's not a direct comparable, I thought, I didn't have a specific price target in mind, but I thought, it was very likely that this company was going to be trading more in the future, just because it's had a lot going for it, and it's going to have a lot more business coming up.
Mm-hmm. And then, at present day, have they been hitting their targets? I mean, have they been living up to what they said in the past? I mean, a year ago, you sort of outlined in the your write-up that management, and as I spoke to you a little bit earlier, that they said both revenue and EBITDA was going to grow by 15% per year. Have they been living up to that?
Well, the revenue has easily gone. Well, it's hard to compare at least 2018 to 2017, but because they made those two. Yes, they are on track to follow through on that commitment so far.
That's awesome. And then what do you think about the CEO?
He's done really well, because he took over, and then the reason he was taking over was pretty much because to fix the company, because it was in a bad position. And so he had to make some really difficult decisions, selling off the part of the company and paying down some debt, and rationalizing their equipment fleet, because activity had gone down. So, I mean, it's the worst thing you can be in a cyclical business, is you're stuck with so much assets on your books, and you can't find any business to make money off of them. And a lot of these are capital leases to a lot of the pieces of equipment. So that was a really tough thing to do. So I think he's done really good. And, the capital allocation, reducing the outstanding shares by as much as they did in the past at pretty good prices in retrospect, I think he's done a really good job.
Yeah, that's awesome. Did you take a look at the proxy statement and see how much of his compensation is tied to the company's performance? Does he own a lot of stock? I'm always kind of curious to hear about that.
I haven't looked at to see how many shares he owned. I mean, I remember way back, when they were doing the initial transformation, he had actually loaned the company a bunch of money at 9.5% interest or something like that. Wow. But so he had a stake. As long as it survived, he was going to get his money back, I guess.
Pretty interesting. And so you wrote up this stock. When did you write this article up?
It was May or June last year.
Yeah, and
2018. Yep.
And when do you think? I mean, you're just continuing to plan. I know you didn't really give a share price, but you just plan to hold it for a very long time. I guess I'm always curious to hear what would make you sell. What risks do you see with this business?
Well, they have a really concentrated customer base, right? Because really they've got 5 clients out there. So the mining company Teck, which is in British Columbia, and then there's 4 different companies that are in the Alberta region. So you have Imperial, Canadian Natural Resources, and Suncor Energy. Mm-hmm. And then there's another company they consider Syncrude, which is just a joint venture between basically Suncor and Imperial Oil, which is kind of part of Exxon in a way. But I would say it's still going to be cyclical. If they had a huge safety incident, they would lose business, I think, and that would cause me to sell. Or if they really started to pile on a lot more debt load, that would cause me to sell as well. Because in the contracting world, and I think it's kind of similar when when companies are evaluating who they want to do business with, they just kind of do a financial evaluation to make sure they're strong and they're going to be around for a number of years, and then also if their safety record's really good. So if there was a big safety incident that would happen, I would sell, and then also if their financial conditions started to deteriorate further, then I think I would sell as well. But it's going to be tough. Because this is cyclical. There's going to be a lot of momentum and irrational momentum that takes this stock beyond what it might be intrinsically worth over time as well. And if that got too far over that dollar figure, then I would sell as well.
Sure. Interesting.
Yeah.
That is very interesting. Is there anything else that you'd like to talk about this company?
No, I think that I've covered mostly everything that I want to talk about.
How can people, Alex, get into contact you if they want to talk about this business with you?
So I have an email. It's called alex@stockwriteups.com, and they can just send an email to that, and I would be happy to.
That's awesome. What stock
converse.
write-ups is that like your domain or something?
Yeah, that's where I posted all my my articles, and I have a podcast show as well, valuestocks.com.
Oh, yeah.
And then so I used to have a partner with named Felix that I used to do the podcast with, but he's been caught up with work a little bit, and so I've been posting a little bit lately. I pick one stock and then I talk about that. It's only for about 10 minutes or so, and just kind of give people a briefing on what the stock's about and what I kind of think its potential is, and then leave it to there. So it's kind of fun to do. Yeah,
no, that's great. I didn't know that, and I'll definitely include that in the show notes for everybody if you want to check out his website or reach out to him directly by email or listen to his podcast. Well, Alex, I want to thank you so much for coming here today to talk about North American Energy Partners. It's definitely an overlooked stock for sure, and one that certainly would be interesting for everybody to take a look at. I want to thank everybody for tuning in with us here today at the Focus Compounding Podcast. If you're not following me on Twitter, follow me on Twitter @FocusedCompound. Alex, are you on Twitter?
Yes, barely.
Okay. Well, do you use it for FinTwit?
Not really.
Okay.
I can send you the stuff afterwards, but I don't use it too much.
Definitely, yeah. Well, I'll include all that in the show notes. But
okay.
Other than that, I hope everybody has a great week. Thank you so much for tuning in with us. We'll see you in the next podcast. Take care.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. Thanks for listening.